So it's my pleasure really to have one of our most senior leader in Mercer with us today. And I'm very happy to introduce to all of you David Knox. As alluded to earlier, David is a senior partner for Mercer and is the lead author of the Mercer CFA Global Pension Index, or MCGPI in short, which some of you have heard of before. Beyond this, he is also the senior actuary for Mercer Australia and the national leader for research and policy as well. Hi, David. Very glad to have you here with us today in Thailand, at least virtually. I was just telling the audience that we would try to prep this conversation in Thai, but then again, Thai isn't a straightforward language to pick up in just a few weeks. And in any event, I know that the audience is very eager to hear more about the index and what are some of the lessons learned, right? But before we get there, I wanted to take a quick and brief step back and ask you just one simple question. So what does a good retirement system look like? What does an ideal retirement system look like?
Well, thank you, Kasin, and good morning, everybody from Australia. It's lovely to be with you. And what I'd like to look at is, what does an ideal retirement system look like? This is some work that Mercer and the CFA Institute did about in 2015, and we came up with 10 principles for an ideal retirement system. Now, given the time today, I'm just going to look at 4 of them. So let's have the next slide. So the first thing to do in looking at an ideal retirement system is to have clear objectives. What are we trying to do, and who are we trying to provide benefits to? I'll talk about it a little bit more in a moment, but when we talk about retirement, money comes from several sources. It may be a government pension, it may be a private sector pension scheme, and it may be savings outside pensions altogether. So we need to have very clear objectives on what we are trying to do and who we are trying to help. The second principle I want to talk about on the next slide, you can have the next slide, there we are. It's really important in a system that is introduced to include as many people as possible to have good default arrangements. Now, we have to recognise that many people will not save for retirement unless they're very strongly encouraged or required to do so. And if it's a mandatory system, if it's compulsory, then we really need very good and attractive default arrangements, so that if I don't make any decision, I still get a good outcome. Now, having said that, it doesn't mean you take away all choice. So let's have a look at the next slide. There is always some need for flexibility. Now, you might think that we're all the same, but in fact, we're not. When we are working, we are often fairly similar. We go to work, we earn some money, we may have a partner, we may have a family to look after. But when we reach retirement, we're very different. Some of us will have a partner, some of us will be on our own. Some of us will be in good health, others will be in poor health. So we need flexibility in an ideal retirement system. So good defaults, but also flexibility is an important part of an ideal retirement system. And the final principle I will look at this morning on the next slide is the really strong importance on good governance. It's really important that members who belong to a pension scheme have confidence and trust in that system. And what do I mean by that? It means that the governance needs to be independent from the government, so it's not a government pension plan. It also needs to be independent from the employer, so the employer is not driving it. So we need good governance that encourages trust and confidence and communicates regularly to members. at least once a year and possibly twice a year about how they're going. And how do we get good governance? Well, there are a number of things that we can talk about, but one of them is to have a strong regulatory system. So the regulator needs to set aside the principles, the framework, and what they expect from a governing board, and then they leave it to the governors with appropriate monitoring. But so just to sum up here, we're looking for a system that has objectives, it has good defaults that generate good benefits, there is some flexibility, and there is good governance.
All right, thanks so much there for the backdrop, David. So just a quick recap. We want a system with clear objectives, having broad coverage, have a good default options for members, who may not necessarily be involved all the time in their selections, flexibility, and a solid governance, right? And I believe that the National Pension Fund and the Provident Fund reform that we'll hear more about later today will go a long way in, moving the Thailand system towards those objectives. Right, so I now want to move to the fun part. Well, fun, I said fun with a lot of caveat there. So would you be able to briefly share a little bit about the objective of the Mercer CFA Global Pension Index and what it intends to measure, really?
Sure. Let's have a look at the slides for the Mercer CFA Institute Global Pension Index. What we are doing here is we are comparing pension systems around the world. Last year in 2021, we looked at 43 retirement income systems. And why do we do that? Because there is no perfect system in the world. Every system has its shortcomings and its good parts. And we want to see what we can learn from each other around the world and then see how we can apply it in Thailand, in Australia, in Brazil, in Europe, for example. The 2021 report, as I said, covered 43 systems. Now, this slide is a little bit similar to what I talked about before. It is a multi-pillar approach. Our Global Pension Index doesn't just look at private systems, but it looks at public pension systems and also financial support outside the pension system. So we look at the very broad picture because we want a pension system that will provide good benefits, be sustainable, and have trust. So let's now look at that in a little bit more detail on the next slide. So the first set of questions we look at are questions about adequacy. What benefits are likely to be paid out of the system, whether it's public or private pensions? Secondly, is it sustainable? Can the system deliver, not just next year, but 10 years' time, 30 years' time, even 50 years' time? Will it still be there? And the third sub-index we look at is integrity. Do people trust the system? Has it got appropriate regulation and governance? So let's look at these areas in a little bit more detail. So the next slide, we'll start looking at adequacy. And here we look at a range of questions, such as, is there a minimum pension to alleviate or stop poverty for the old? What about someone who's been in the system throughout their career? What would they get, a replacement rate or a benefit when they retire? Certain design features, savings outside the pension system. Home ownership is also part of financial security. And where is the money invested? If you just invest it in cash, it's not going to deliver very good returns. So we look at the level of growth assets. Last year, the top 3 countries on adequacy scored in the 80s, Iceland, Netherlands, and Norway. Thailand score down at 35. Now, we move from adequacy to the next slide, which is sustainability. And here we look at things like coverage of the plans. What proportion of the working age population are a member of a plan? How much money is being put aside for the future? The level of assets. Demographic issues. Is it an ageing population? Will that generate problems? Are people working a little bit longer? Because if you work a bit longer, then of course your retirement is a little bit shorter. In many countries, there is significant government debt and there is threats to public pension costs going forward. And of course, if the economy is growing, then the investment returns will be better and it's all more affordable. In this case, the top countries with scores in the 80s, Iceland, Denmark, and the Netherlands, with Thailand a score of 40. And then finally, we look at integrity, which covers that concept of trust on the next slide. And here we looked at the regulation, the importance of governance, what happens if something goes wrong, what protection is there for members, the level of communication, and broadly speaking, how much does the system cost? Because people don't like paying a lot extra. So the top countries here, again in Northern Europe, Finland, Norway, and the Netherlands, Thailand scoring just on 50. So what can we learn from this study? And what do we suggest that Thailand should look at to improve their results? And here's the next slide. We make 3 suggestions. Firstly, let's increase coverage of employees and the self-employed in private pensions. Let's make sure all the workers are putting money aside for the future. And we can do that through both a mandatory system, but also to encourage higher levels of savings, both within pensions and beyond. And as I mentioned before, let's continue to improve the governance of private pension plans so there's more transparency, people understand what's going on, and therefore there's more confidence in the community. I haven't got time this morning to look at the full report, but it's publicly available for no charge at mercer.com/global pension index. Thanks, Kasin. I'll now hand back to the panel discussion.
All right, thanks, David. So it sounded like a lot of the lessons learned more or less mirror what we see in your coverage on the ideal pension and retirement system. I now want to introduce you to our second panelist, who is a little bit closer to home, and I'm very thrilled to have with us here Janet Lee, Asia Wealth Business Leader and Partner at Mercer Hong Kong. Janet has extensive experience working closely with pension systems in Hong Kong and Taiwan and China since its very early development. And with that, may I introduce Janet Lee onto stage, please. Virtual stage. Right. Hi there, Janet. So Hong Kong was also part of the index this year, as well as and pension development in Hong Kong has in some facade quite similar to Thailand, beginning with the voluntary provident fund system or so before the mandatory system or the NPF was introduced. We know that Thailand is trying to move to a mandatory system, or at the very least auto-enrolled system, as well as I believe we'll hear more later from the SEC. Can you share a little bit on how the systems have developed through the way it is, and what are some of the learnings we can get from the index? What are some of the socio-economic and cultural forces and our context that we should take into account if Thailand is to learn from Hong Kong? And what does the future look like?
Sure, thanks, Kasin. First of all, Sawadika. So happy to be presenting here together with other prominent speakers and experts in the pension space. So refer to Kasin's question, Hong Kong came a long way to where it is today. So let me just provide some recap. Back in 1995, the Hong Kong government introduced the Mandatory Provident Fund Schemes Ordinance and approved the related supplementary regulations in 1998, 1999, and year 2000, respectively. And in December 2000, it was the formal commencement of the mandatory provident fund scheme in Hong Kong. It was certainly a milestone to the Hong Kong retirement system, especially Pillar 2, since retirement savings no longer is voluntary, but mandatory, as reflected in the name of our system, which have a mandatory into its name. And so unless exempted, all the employees or self-employed between the age of 18 to 64, they need to join the mandatory scheme. And about 85% of the employed population is now covered under the MPF. And prior to the MPF, there was the existence of the Occupational Retirement Schemes Ordinance, and it's a short form of ORSO, ORSO. It still exists today, and it is a voluntary system with limited coverage. So both MPF and ORSO together constituted the second pillar in Hong Kong, and they cover close to 100% of the working population. And the total assets over the year have grown to more than $150 billion. So until the end of year 2020, so there were more than 10 million MPF accounts that spread across around 4.5 million members. And you would note that 10 million is even more than the population in Hong Kong. So we'll come to it later in the recommendations and relevance to Thailand. So the average balance per member was around 210,000 Hong Kong dollar, roughly around $26,000. Another milestone for the Hong Kong retirement system was in April 2019. There was the introduction of the tax-deductible voluntary contributions, and in short form, they call it TVC. And members can enjoy the tax concession within the cap of for subscription into eligible MPF and annuity products. And up to earlier last year, the number of accounts was 53,100, with total contribution AUM at around $4 billion. And you can see that these amounts of money, whilst they started small, they have over time aggregated into much bigger sum and meaningful sum. Then aside, the government also launched a life annuity scheme, which provide an option that did not exist in the market before, and it truly protect the longevity risk of the individuals. So when I compare the system in Hong Kong with where Thailand is right now, I'd say that it would be very similar to before the launch of the MPF in Hong Kong, and when we have the ORSO in place. And so the benefit for Thailand is the opportunity to learn from the lessons that Hong Kong have taken 20 plus years to get to know. And so you will be on a smoother path. And so there I have a few thoughts to share. So number one, as I mentioned, and touch on, you will note that the number of accounts far outweighs the number of individuals that's in the system. And recently, the MPFA, the related authority to MPF, they've embarked a project to introduce the eMPF in order to consolidate the administration functions, which right now sits with the individual provident provider or MPF provider. So I was trying to put in place the relevant wordings in the Thai context into this single centralized system under the MPF. This makes total sense because the number of accounts kept increasing as people change job, and so administratively it's less efficient. And then, of course, on hindsight, it would have been better that it was introduced at launch of MPF. But as with many policies, we do appreciate that the design might not be 100% perfect at launch. And then secondly, and David also covered just now, is the proper system design. So we shouldn't lose sight of the objective of any retirement system is to provide, as to support the individuals during their retired life, and therefore sufficient amount of contribution will be needed to generate the needed sum of money, leveraging the time value of money and investments. And this also needs to be considered holistically with the other pillars in the market and how these all come to play on the overall replacement ratios. The contribution rate to the Hong Kong MPF system is not uncommon compared to other systems. It is 5% of employee plus 5% from employer. However, the devils are all in the details. There is a cap to the contribution, and the cap hasn't been adjusted a lot since the launch of the MPF. Then the third point is arousing proper financial retirement awareness. From basic financial 101, we all know that a $1 today is worth more than $1 10 years later. That's the simple present value of money. So therefore, any voluntary contribution to supplement the replacement ratio would require proper financial retirement awareness as well as incentives to achieve. So in terms of financial retirement education, we have seen that many initiatives in other markets, as well as in Hong Kong, is to bring it forward when the individuals are still in school. So there were also propaganda to promote financial education, especially like in Hong Kong. There was a deliberate entity set up to promote financial literacy locally, and then how to plan for retirement. Then in terms of incentives, the government needs to balance the incentives given today to induce contributions into the system for the future benefits of the country. Then, of course, often regulator, government officials, they only have a finite term of appointment, and therefore it requires a strong commitment from the person in power to have that long-term vision into the future. And then, of course, I just want to echo very briefly the point David made about the governance of the retirement scheme, having that arm's length from the employer, and also be able to have autonomy in doing proper education and communication. So I think these are some of the lessons learned that Thailand can take as reference.
Thanks, Janet. I'm very hopeful too that we can learn from the developments that we see in Hong Kong, and there were a lot of keywords. Especially I picked up a few. Longevity risk. That is something that we don't necessarily think about in Thailand too often. You talked about it having a centralized administration system. There's been some developments around that, and finally, about membership awareness, especially since their early development years. And I would also add to that user experience as well. Those would be some of the key things that we would need to think about. So going back to the index quickly, the index touched on adequacy, and a lot of the research has suggested that life path or a target date type funds can help to increase the probability of having sufficient retirement savings by leveraging on their internal behavioral bias and so on. Based on our most surveys done for Thailand, however, only 10% of companies have provided such options. And there are also some concerns around target date having high equity allocations, especially in their earlier years, and hence a lot of volatilities that come along with it. So a fund committee has typically tend to shy away from making the offer, as all hells break loose when portfolios go negative even for a single month. So how has other countries, including Australia, Hong Kong, or some other systems you've worked with, tackled this particular dilemma, and how would you? So David, if I may start with you first.
Sure, thanks, Kasin. I think it's really important that we see that the pension system and pension funds are investing for the long term. So as you say, if a market drops for 1 week or 1 month, when we're looking at a 40-year time horizon, let's not get too fussed about it. It's important we come back to the objectives of what we're trying to do. We're not trying to save money for next week. We're trying to save money for retirement. And I think, therefore, it's really important that we see a portfolio that has a good share of diversification. Yes, in equities, yes, some money in fixed interest, but they're earning less than they have earned historically now. Some property. I don't think we need to shy away from equities. And I would say that for members under the age of, let's say, 45, then there should be a very high exposure to equities, because and other growth-related stocks or investments. We don't want to be overly conservative. Now, again, then as you move towards retirement, it depends a little bit on what the money is going to be used for. If the money is going to be given as a lump sum benefit at the age of 60 or 65, then we need to think about some de-risking mechanism, reducing the risk in the last 10 years. On the other hand, if that money is going to be invested to provide income for the next 10, 20, 30 years, then I don't think we need to de-risk greatly. I think we need to recognise that even at the age of 60, we're investing for another 20 or 30 years. So again, it comes down to what are the objectives? What are the benefits going to be used for? For example, if the benefit at the age of 60 is going to be used to buy a house or repay a mortgage, then you need to start de-risking or earlier. But if it's going to be then invested in the markets to generate an income for another 20 years, then let's not de-risk too quickly. So again, it comes back to objectives, and the objective should be to earn a good rate of return throughout the period. And I think not only in Thailand, but in many countries, we have seen conservative investments because years gone by, government bonds, for instance, fixed interest, generated quite a good and reliable return. We don't live in that world anymore. And we want to earn more than 0 or 1%. We also want to spread the risk across several assets and asset classes. So I'm certainly one that says for people under the age of 45, a good diversified portfolio, but a good exposure to growth assets.
All right, thanks, David. I smiled there because, the low yields is definitely there. And, I tried turning cryptocurrency as well, and that didn't work out so well for me. But we'll touch on low yields a little bit more in my next question. But before that, I wanted to...
my comments do not and should not be represented as personal financial advice.
Yeah, same goes for what I said as well. So, Janet, if I can quickly turn to you. So, what are the lessons learned in Hong Kong when it comes to trying to push these life path or target date funds to become the default?
Sure. First of all, I think we can consider having another webinar on cryptocurrencies, NFT, etc. So that's a lot to discuss. So back to your question, Kasin. It is very common to see these kind of pushback. And so I just wanted to reference a study for sharing. And so it was on an also scheme with a few thousands of members. So it was examined and there were analytics carried out to show basically the individual's age versus the risk level of their investment. And then, of course, everybody would appreciate that equities and single country investments are higher risk and fixed income or cash are lower risk. So as we put that into a chart, the standard x-axis, y-axis, your age versus your investment profile, the results were very interesting in that we have observed that younger members for that scheme, where we expect them to have higher risk appetite and should be investing in higher risk investment. And of course, vice versa for more mature members, we expect them to have slightly lower risk appetite and should be investing in slightly more conservative investments to be from our analysis. But from the outcome and the results, it's actually reverse. It shows that the younger members, in fact, invest more conservatively than the more aged members. And of course, there can be various reasons to this. But coming back to the retirement planning perspective, and as David said, we are not saving for a week later, but we are saving for long term. The investment pattern is not considered sufficient to create positive impact for retirement savings. And I think that one force that we cannot undermine is inertia. And in many studies which show that individuals who are often not engaged in the retirement management, they end up in a default option for a prolonged period. And so I still recall that at the beginning of the MPF system, the default option generally at that time, if members don't make a choice, was a capital preservation fund, which effectively is just preserving the capital, and there's literally like no returns. And therefore, when you look at the real value of money, it was losing when we consider inflation. And so since 1st of April 2017, the Hong Kong MPF system has launched a default investment strategy for members. So who those don't make a choice, silence on their choice, or they can actually make an active choice into this default arrangement. And this default investment strategy adjusts the investment strategy from time to time as the members' age change. And then over time, the default investment strategy has also delivered positive average performance. And whilst there were up and down, it's important not to lose sight of the long-term picture, which is important under retirement investment. And with a lot of criticism, the MPF system as a whole, the average return that's generated across the years, across the funds, have been around 5.5%. So it's still a decent growth percentage, as I would like to quote, having the head of the investment consultants on. And so it just demonstrates the importance of keeping to the proper long-term investment strategy and not just be bothered and affected by short-term volatility.
Right, and in a sense, we are sort of forced to consider more growth assets, given the global low yields that we are experiencing as well. We've seen that traditional strategies that rely simply on the mix of basic fixed income and equities may not suffice any longer. So what I wanted to ask really is, what are the roles of private markets and alternative asset classes such as hedge funds or even cryptocurrencies, where I'm obliged to mention? Are they necessary from your point of view, and why do some markets tend to be quite reluctant to offer such products? So David, if I can turn to you first.
Yes, look, I think we want to be looking at a broad range of assets, and I think even things like private equity and private debt are an important part of the broader portfolio. We are looking to generate a return to members. We are looking to generate a return for their retirement. So I think we need to look at a broad spectrum. It doesn't have to be just equities and bonds. I think property, real estate has got a component, private equity, maybe cryptocurrencies, but I'll leave that for others to make a call on. But I think we need to look at the broad universe of investments, and we need to look at investments beyond the home country. I think many countries have a home bias. I know that's very true in Australia. And we are seeing many of our funds now investing more and more offshore, and that, of course, is diversifying the risk as well. Now, there's a currency risk in that as well, which may be hedged if that is desired. So I think it is becoming more complicated, but I think we need to look at a broader range of assets, recognising the risks of each asset class. There's also a component of education here. Let's educate the members so that if there is a bit of volatility and the market drops 20 or 30%, then let's not, the members should not be spooked by that. I'll give a very simple example. In 2020 now, March 2020, when COVID first hit, share markets around the world dropped 30, 40%. And in Australia, members have the right to choose and to move out of one asset class into another. We saw some members, a minority, but some members opt out of equities at the bottom of the market into cash because they were spooked and they were scared. The markets recovered and, of course, have then gone on to do bigger and better things. And these members, some of them, are still in cash. So I think there is an element whereby I don't want to take choice away from members. We need that flexibility I spoke about, but there's also an important component of education to say you are in this investment for the long term. Don't worry about the day-to-day share market movements.
Right. And I guess that's a similar experience for Thailand as well, I would say, where the markets dropped and then people are spooked and panic. And I think that's where we see a growing need to have the strong default options as well.
Yeah.
Where sometimes members can just look beyond these short-term fluctuations and focus on what really they will get at retirement. Right. So for Hong Kong, the MPF space, do you see a similar broader investments into various asset classes, or do you still see a lot of home bias and a lot of focus in the traditional fixed income and equities?
Unfortunately, in Hong Kong, I'd say that we are still much behind Australia in terms of the investment best practice or governance. Then, of course, it does vary as well. For MPF itself is has very restrictive investment scope and universe. So currently, no private markets and alternative asset classes are authorized investments. And in fact, in a recent CFA Hong Kong event, which I spoke at with the other industry experts, we did raise that it should be considered by the government over the medium to long term to open up and allow alternatives investments and private markets investment be considered. And of course, we know that it's not going to be happening very soon, given the speed that we have seen from the government introducing new measures. But at least we know that if we don't put that out, it will never happen. And then for also the investment scope is much more relaxed. So currently there are schemes and investment funds that invest in more diverse assets. A very small percentage also invest into private markets or alternative investments. But I have to say that that's not the mainstream. And I think there are two considerations. One being liquidity, because often these investments don't have daily liquidity, whereas these member choice scheme, they probably allow their members to switch from time to time and as frequent as perhaps once a month. And so considering the potential movement of the members' asset and the long-term nature of these investments, this needs to be taken into account of. And then secondly, which we have also discussed at the earlier part of the panel today, is financial education. And back to the liquidity point, if investors aren't educated on the investment nature of these private assets, but they don't have daily liquidity and often less transparent in their value, market value, and so on. And if they liquidate earlier than the mature period or the end date of the investments, they usually will suffer a loss. And so that is also come back to the importance of financial education, ensuring that the investors are well equipped to make their choice and be able to read and understand their own investments.
All right. We are down to the last 5 minutes of our session. So I only have just one last question really. And I wanted to turn to Janet, since you are closer to home on this topic, to touch on governance and ESG a little bit. And David, do feel free to weigh in towards the end as well. For Thailand, ESG has been talked about, but it's mostly talked about at the company and securities level, but rarely we have seen it being talked about at the portfolio, at the board, at the committee, and at the governance level. So what I wanted to ask is how should fund committees consider integrating some of these ESG considerations into their pension governance, and what can smaller plan sponsors do? And any other remarks for Thailand as well on that front?
Oh, thanks, Kasin. I'm sure David will have some important points to weigh in as well. But let me just start with, at Mercer, we view sustainable investment as a very critical element in protecting beneficiaries' returns in the long term. And this is especially important in times of changing climate, environmental degradation, and other complex social challenges. And of course, within sustainable investment or ESG, climate change is one which is getting a lot of attention and focus on, with COP26 and the net carbon emission pledge, etc. I think nobody in the industry would not hear about it already. And of course, the level of understanding may vary. And so how we would think that is a proper way to look at it is we look at it in the form of a responsible investment pathway, where each investor or client, or whether it's provident fund or the government or even the future investment schemes, they might have slightly different starting points, but we hope to take our clients through their journey along this pathway. And so maybe just very quickly, the pathway starts from beliefs, where it means that the organization's philosophy and values on ESG, which forms the foundation for the next step, are being set. And then onward, there needs to be a policy which sets out high-level direction for the development of guidelines and manuals, which will lead to the third element of process that ensures effective implementation. And then lastly, onto the portfolio, where investment products is a reflection of how robust the previous building blocks were. And these four main elements should be incorporated in throughout the journey. And they are screening, integration, stewardship, and investment in solutions. And then, of course, there are a lot of talks around how pension funds should do it, but how should they do it? And so we have worked with clients across the globe on helping them through our analytics for climate transition analysis, which is a tool that we set up to help our clients to look into the transition capabilities of their portfolio. And so putting it in perspective is how green is your portfolio is right now, or how brown it is, and then where you want to be, and the pathway from that brown to green or green to greener is how we help our clients set out that journey. And that's, of course, a more standardized way to look at how we can introduce sustainability into pension schemes. And generally, we see that there's definitely the need for standard setting in the industry and maybe broadly in Thailand as well, as we have seen this emerging in many other countries. Going forward, I think before that we have some convergence, there might be some divergence to exist, because each location or market will want to consider their own unique way to look at it. However, it's a process, but it's important that a country or system kickstart. So back to applying closer to the topic today, pension in Thailand, the provident fund scheme, the retirement schemes. To start with, each employer or scheme sponsor, they can begin with their own little step around building out a governance charter that document how they incorporate sustainability into their pension scheme investments, then also develop a dashboard to monitor so that it becomes more systematic. It is always best to set up these beforehand and any crisis happen before we are being challenged, rather than setting up when there anything happen, because it's always help us to form a more objective view. So I encourage the employers or scheme sponsors to think about your own governance charter, where they are, how can you improve it, and how can you do better?
All right, and David, any final remarks from your end on this topic?
Yeah, Janet has covered a number of perspectives very well. I just add a couple of different perspectives. ESG is going to become more and more important around the world in investment markets. There's clearly a trend there. And I highlight the trend from two different angles. One is the members. Many individuals and members are asking questions about what funds are doing in respect of climate change, in respect of ESG. For example, in Australia, we have annual member meetings, a bit like shareholder meetings. About half the questions asked to the governing board are about climate change, ESG factors. So members are interested. The other point I would make is regulators around the world are instructing, formulating, developing more and more policies, procedures, and standards. So it's coming from both angles. It's coming from the members, and the regulators are saying, we want this industry to be sustainable, and if you don't think about climate change, you're not going to be sustainable.
All right, sounds good. And yeah, it's sustainability has also been a key topic of discussion in Thailand as well. And I do look forward to more and more fund committees adopting this similar mindset as well. And we are at the end of the hour. I know we have a lot more to discuss, and we hope we can leave this to some other time as well. But thank you so much for your time today, both David and Janet. And yeah, very happy to have you here with us.
It's a pleasure.
Thank you.